Okay, so I want to talk about the problem of moral hazard and its association with the subprime mortgage crisis. This will serve as an extended introduction to Dodd-Frank and to why Dodd-Frank has become law in the United States. Okay, so these really are two separate points, but I'm going to pack them into a single lecture to get us started here. Okay, maybe you don't remember this. For most of us, this happens when we were much younger. But I sure do. I remember it. The subprime mortgage crisis was the worst financial situation in the United States since the Great Depression in the 1930s. And it came about as a result of several different actors, all of them, I would say, behaving in risky ways. If you think about capitalism, capitalism is a system where competition is seen as being healthy. The idea at the heart of capitalism is that if different agents or entities compete with each other to provide customers in the general culture with a particular product, then the general culture will be benefited by virtue of their competition. Because the competitive environments will spur them on to find innovations and efficiencies and various other kinds of advances. And this will be of general benefit to the society because the lower costs associated with more efficient production processes will be passed on to the customer and so forth. Okay, but at the heart of capitalism also is the idea that with competition and with the business enterprise comes a certain amount of risk. And you need to keep that risk in mind as a business person as you engage in the business enterprise. If you want to borrow money to expand your business, that's great, but you have to weigh the fact of the borrowed money over and against the prospective revenue stream that you're looking at making with that borrowed money. And of course, as part of the business enterprise, if you're a good business person, you want to take on a certain amount of risk. There's no reward in capitalism without a certain amount of risk. But you don't want to take on so much risk that you do things that are foolhardy and make decisions that actually are not warranted by virtue of the statistics or by virtue of the business prospects. Are people hot in here? Is it hot in here? I'm a little hot, so I agree with you, but I'm not sure if I can do anything right now. Sorry about that. There are several agents in the subprime mortgage crisis plot that I'll talk about. I call it a plot because it's basically an interesting extended story. The government is certainly one of the participants, but also lenders, and that includes mortgage originators, it includes banks, it includes credit unions. Mom and pop definitely played a role. Okay, and all of these agents together essentially took on much more risk than they should have done, resulting in a very precarious situation that almost brought about this country's, almost brought about a depression really in this country, although it was averted, and I'll talk about how it was averted a little bit later. First of all, the government played a role. Call it the subprime mortgage crisis. The government played a role. In the 1990s, times were good under the Clinton administration. And there's been this long-standing part of the American dream that most people subscribe to, and that is that you haven't really made it in America unless and until you own your own home. Okay, that's just kind of at the back of the American mind, is you've got to own your own home if you really want to live the American dream. And the government wanted to encourage this, and times were good in the 1990s, and so it was thought that the government could perhaps through policy making expand home ownership to customers who normally, otherwise, would not have been able to obtain that, would not have been able to achieve home ownership. Okay, now, when you buy a home and take out a mortgage, the first thing that the bank looks at, the lender, is your credit score. We've talked a little bit about credit scores before as ways of measuring risk in this class. What's a good credit score? 780. 780 to 850. These are good credit scores. What's a bad credit score? 400 is a really bad credit score. Okay, 620 and below, subprime. And it means what it sounds like. These are subprime customers who wouldn't be the ideal mortgage candidates for a bank. Instead, they would be seen as riskier than normal kinds of, more normal kinds of borrowers. 700, something in the middle. And usually, these people, the subprime customers, get either no loan at all, or they get a very high interest loan. Okay, and the subprime customers were the kinds of customers that the government wanted to help out through policy making when times were good, to try to expand home ownership to people who otherwise wouldn't have been able to achieve that, which is, of course, a nice ideal, the sort of thing that makes everybody feel good. So the government let a famous law called the Glass-Steagall Law, they let it lapse, and in fact they repealed two parts of it. And all you need to know about this for the purposes of our discussion today is that Glass-Steagall separated investment banking from commercial banking, and in doing so, it put the brakes on loans to customers who are too risky to obtain those loans, too risky as borrowers to be able to obtain those loans. Is that a hand? Yeah, for sure. Glass-Steagall is a famous law from the 1930s. It separated investment banking from commercial banking in the United States. But all we need to know about it for our purposes today in discussing the subprime mortgage crisis is just that Glass-Steagall put the brakes on lenders who might otherwise be tempted to facilitate mortgage originations for customers who are really not statistically meriting a mortgage. Okay, so the government also let the mortgage lenders know that in letting Glass-Steagall lapse and actively repealing parts of it, they were also going to provide tax benefits and a certain amount of financial backing if the lenders got into trouble lending to subprime customers. But the government wanted to incentivize and facilitate mortgage origination to customers who, like I said, would not otherwise have been able to obtain home ownership. Well, the mortgage lenders definitely played a role in this. They were another participant because they got real greedy. If the government is backstopping them, giving them special tax benefits and also certain guarantees that if they got into trouble in their loan book, then they could obtain substantial support from the government. Okay, no wonder they got greedy, but they took the ball and just ran with it. And they started loaning subprime customers all sorts of mortgage loans that those customers really should not have had access to. They were taking on too much risk, more risk than was merited by the business climate and by the statistics. Okay, but they did so primarily out of greed. The greed was driven by the belief that the government would backstop them and by their own desire to compete with other mortgage originators and to expand home ownership to customers who previously would not have been candidates for them. Okay, mom and pop played a role because mom and pop bought too much house. Mom and pop couldn't control themselves. A lot of Americans, this is also part of the American mindset, maybe even part of the American dream. A lot of Americans live beyond their means. Okay, they borrow too much to facilitate a lifestyle that is actually too expensive for their incomes. And that means buying too much car, and in this case, buying too much house. And the stories out of that era, this is primarily all occurring, by the way, from about the time of about the time of the repeal of Glass-Steagall through 2007. 2007 to 2009 is considered the subprime mortgage crisis era. But the stories out of that era are really quite extraordinary. So customers with incomes of $60,000 a year were being given mortgages for $480,000. Customers with incomes of $120,000 a year would have 3 mortgages of $500,000 apiece. Crazy, crazy stuff was going on. Obviously stuff that people were going to struggle seriously to be able to pay back, but these mortgages were originated because the lenders were greedy, mom and pop couldn't control themselves, and the government decided to backstop this kind of behavior. Okay, there were a lot of exotic products created, exotic mortgage products that were made at the time. For instance, here's one example of an exotic such product. Okay, this is called a balloon loan. Most mortgages are fixed interest mortgages. So if you take out a mortgage at, say, 4%, it usually remains 4% over the duration of the loan. But sometimes you can take out exotic mortgages that have the following structure. They have a really low APR at the beginning, but then after a certain period of time, that spikes to a much higher level. Sometimes you'll see credit card companies use gimmicks like this to try to push their product. They'll say 0% APR for 12 months with the hope that you'll be hooked and interested in the product, and then after that the APR will spike to 20 or 25% or something. Well, in a balloon loan, you might start out with a 2% mortgage interest rate for the first 5 years or so, and then at the 5-year mark, it will balloon to a 20% interest rate. Now, this kind of a product actually does make sense for some kinds of customers, but for the great majority of the customers that it was being sold to at the time, it doesn't make sense at all. What's an example of a customer for whom this product might make sense? Thanks, Maddie. That's right. Yeah, somebody who could pay it back before the balloon criterion kicks in. That's an example of such a customer. That might be somebody who's in med school right now and has 3 kids and needs house now, okay? But will be making, and isn't making a lot of money right now, but will be making a ton of money within a couple or 3 years, and will be able to pay it back before the balloon criterion kicks in. That's an example of a customer who this might work for. But who it was actually being sold to were people who saw that 2% APR and thought, well, I can pay that right now on a monthly basis. And maybe they had dreams of rapidly increasing their income through some scheme or something, but no practical plans for doing so. And because the lenders got greedy and the government was backstopping this, mom and pop took on these kinds of exotic financial products that they otherwise would have been, one would hope, too prudent to accept. Gesundheit. Well, the result of all this was that by about 2007, after many years of this behavior, a large number of Americans began defaulting on their mortgages. They began defaulting en masse. And when a few people default on their mortgages, that's considered normal for banks' loan origination departments. They actually make provisions for that, and that's built into their statistical models. When a whole bunch of people begin defaulting at once, that's a problem. A mortgage is a secured loan. Okay, a mortgage has a certain collateral to it. Okay, what's the collateral in a mortgage? What's the security? The house. The house. Right? Some loans that are secured loans give you lower interest rates. Come on in. Your car loan is a secured loan because the bank can repossess the car. Okay, if you default on the loan. A credit card loan is not secured, so the APR is much higher. The interest rate is much higher because it's not a secured product. But the house is the collateral in the case of a mortgage. And when a bunch of people began defaulting on their mortgages all at once, banks foreclosed on them and took possession of their houses. Now, banks are not really in the house ownership or house leasing business. They want to refurbish the house if necessary, do what they need to do, and then put it back out on the market. Okay, and what happened was a bunch of people got foreclosed on and a whole bunch of homes entered the market at once. So supply surged and demand remained constant. What happens to prices in a situation like that? Everyone remember from micro? Prices collapsed. Okay, and people who weren't involved in this, who were paying their mortgage normally, found their houses plummeting in value. Okay, and they were underwater, and it becomes hard to move. The house becomes less liquid when there's too much supply, and it's a bad situation for everybody. Okay, so everybody, that value of everybody's house, like all across America, everybody, all the houses, plummeted at once. Now, when mom and pop were trying to pay their mortgage, scrimping and saving to pay their mortgage, they cut back on other kinds of spending. About 70% of the American economy is based on retail consumer spending. And when mom and pop stopped paying for all the other items that they usually were paying for, that meant that other industries faced difficulties as well. So what began as contagion in the mortgage market spread to other areas of American commerce as well, and ultimately led to the worst recessionary environment since the Depression of the 1930s. Okay, now the government actually did something real controversial at this point. The government bailed out the mortgage lenders. This happened in 2008, 2009. Okay, late 2008, and then throughout the first half of 2009, the government did something unprecedented, something that it previously didn't do in capitalist markets in the 20th century. Government inserted itself into the situation, and instead of letting a bunch of mortgage lenders all fail, which they would otherwise have done because they had taken on excessive risk, and when a business, of course, takes on excessive risk, and that risk turns out to be risky, businesses fail. But the government stepped in and provided bailouts to the mortgage lenders to keep them in business. Okay, the government bailout was an unprecedented thing at the time, and it was really controversial. Why was it controversial? Well, it was controversial because of something called moral hazard. Moral hazard is a term that's referred to the rewarding of bad behavior. Okay, I've got 3 little kids. They are 5, 3, and 1. And I'm about to have my 4th. Okay, now that means I am, as a parent, constantly in the business, unfortunate business, of disciplining my kids when they do wrong. Okay, the 3-year-old has a problem with running the water in the bathroom sink and then making a big mess. So she is currently not allowed to go into the bathroom by herself without supervision because she can't control herself. She takes the water and flings it all over the mirror and the bathroom counters and the floor and everything. Okay, if I did not discipline my 3-year-old, if every time she ran water in the bathroom and it overflowed the sink, or she dumped it on the mirror or on the counter or something, if I gave her a candy bar every time she did that, what would she be incentivized to do? Keep doing it, right? And that was why the government bailouts were controversial. Because it was seen by a lot of people that if the government did this, then the people in the mortgage origination world who had started taking on excessive risk and getting greedy and doing things that weren't warranted by the business climate, okay, these people were going to do that again. And ultimately, actually, I said at the beginning of the lecture that the mortgage lenders got greedy because they believed the government would backstop them, and ultimately, actually, they were proved right. The government did backstop them. And they got bailouts from the government. How do you think those bailouts were paid for? Anybody want to take a guess?
Taxpayer money.
A little bit was taxpayer money. That's correct. And a little bit of it came from people all over the country, increased taxes. But primarily, actually, it came from borrowed money. Taxpayer money paid a little bit. But primarily, it came from borrowed money. Prior to the subprime mortgage crisis, the federal debt was about $5 trillion. Okay, and that was in 2006 or so. And it surged during the subprime mortgage crisis. I want to say at the end of the subprime mortgage crisis, it was about 16 trillion. This is primarily money borrowed from China. Okay, so China and Chinese lending, purchases of treasuries, American Treasury bills, ultimately led to the United States being able to extract itself from the subprime mortgage crisis without too many consequences. Now the federal debt is much, much greater. I want to say it's like, what is it, 20? Can someone look this up? There are like debt clocks on the internet. This is like 25 trillion? You can, all you have to do is just Google it. There are all sorts of like debt clocks you can look at. I can't even conceive of a number that large. It's 28 now. Oh, we're at 28. Okay. Good to know, I guess. We kind of went on a bender under the, well, we went on a bender over the last year, actually. So the ultimate outcome is the federal debt exploded as a result of this. And there weren't that many consequences. Okay, and the justification, just so I can speak on behalf of the government's actions, justification at the time for the government bailout was systemic risk. Systemic risk. If we don't do this and bail out the bad actors and the mortgage originators who took on excessive risk, then there will be a loss of confidence in the system. Runs on banks, people will pull their money, no one will invest. And that's going to lead to all sorts of other problems if we don't bail out the bad actors. That was the justification, was systemic difficulties. Okay, just out of curiosity, what do you guys think is going to be the end result of that? Does anybody have any idea of what's going to happen to that? What's that? Yeah. So what's the end result of the federal debt? Like, where are we headed here? Like, what's going on here? Where are we going? I know, it's like that scene in the Charlie Chaplin and the Chocolate Factory movie where it's like the crazy like tunnel scene where they're like rowing the boat and they're like, we don't know where we're going. We have no idea. Like we just keep rowing. The rowers keep on rowing. Does anybody like have any idea what the end game here is? Spencer?
Well, didn't you say like that we borrowed a lot of money from China?
We did.
So like
they did this because they saw this as a way of gaining power over America. That's why they decided to lend us money at the time. Go ahead.
Yeah, because that's where I was going with it. Like, at what point, because this is like trillions of dollars, is trying to really say like, okay, we want our money back.
Yeah.
Like, what's going to happen then?
Yeah, I've heard and read different things about that. So at this point, we are in for a whole bunch of money to the Chinese as a result of excessive living, without a doubt. But I was reading an interesting article recently that said that if you're in debt for a little bit, that's your problem. But if you're in debt for a lot, that's the lender's problem. Because right, they're now in bed with you, and if you default, then they get hurt too. So I don't know what we are in for a lot with them at this point because of excessive living. So I don't know what the end result here is. They have begun dumping treasuries, so maybe they're losing confidence in the dollar. I'm not sure. Any other thoughts on what might be the endgame scenario here, Maddie?
Do you know how much money other people have in the U.S.? Do you know how much money other countries have in the U.S.?
Good question. I do not. It's much less than that. Yeah. So call in our debts from them and pay off our own. I think probably, I'm just speculating here, no one knows. I think probably the end game here is inflation. A lot of inflation. Okay, because I think that money printing is the only way the government can pay the debts, which means the dollar weakens, which means standards of living drop. Now, that doesn't necessarily mean that the next generation is going to have a lower standard of living than us. At the same time, there are deflationary forces that are also at work. For instance, the price of your flat screen television has plummeted over the last 10 years, as has the price of your smartphone and the price of your laptop, etc. There are lots of deflating forces that make the standard of living remain the same or improve by virtue of the fact that technologies are improving. But the debts at this point are so huge, and again, I'm just speculating. Hyperinflation may be the only result here. It's going to get pretty bad probably around 2030 or so. Anyway, this is macroeconomics and the ethics of macroeconomics, so it's kind of speculative at this point. Are there any questions about the background of Dodd-Frank? Questions or comments? I find all of this very interesting. All right, let's talk for a few minutes about Dodd-Frank. And I'm not going to get a chance to go through all of this presentation. I'm really only going to be able to talk for about 5 to 7 minutes on this because I want to go over the sample paper for a few minutes too. Dodd-Frank is a sweeping piece of federal legislation. Usually the government's mode of operation is a scandal will occur or some crisis will occur, and then the government will pass sweeping legislation to regulate what went wrong in that recent scandal or that recent crisis. That's a pretty standard government mode of operation. And Dodd-Frank was passed as a way of regulating what went wrong in the subprime mortgage crisis. Then as time goes on, usually what happens is businesses find these regulations onerous and difficult to abide by and hard to pay for. It gets expensive. And so what they do is, what the government does is it begins loosening restrictions. And then another crisis will happen and the government will tighten restrictions again and regulate heavily again. But in Dodd-Frank, it's divided into multiple different parts. And an important first part of Dodd-Frank was the Financial Stability Oversight Council, or FSOC, FSOC. Its purpose was to identify risks presented by bank holding companies and non-bank financial companies, to promote market discipline, and to respond to threats to the stability of the U.S. financial system. Okay, so like Sarbanes-Oxley, it establishes certain federal regulatory bodies so as to help regulate what recently went wrong in the subprime mortgage crisis. And another important part of Part 1 of Dodd-Frank is deposit insurance reforms, especially the FDIC assessment component. FDIC assessments for most banking institutions are strengthened by Dodd-Frank. You don't have to remember what they're now based on. You just need to know that they're strengthened. Your checking accounts and your savings account at your local bank is insured by the FDIC for up to $250,000. And another important part of Dodd-Frank is mortgage reform. So like I was mentioning, the story in the subprime mortgage crisis is really about predatory lending institutions finding vulnerable moms and pops who they then exploited by offering them financial products that many of those people didn't understand. So Dodd-Frank creates a federal duty of care which requires the licensing and registration of all mortgage originators. It requires that borrowers have to have a documented ability to repay the loan and have to be provided with a net tangible benefit. So the hoops that borrowers have to jump through in order to originate a mortgage at this point are much greater than they used to be prior to Dodd-Frank. Loans can't have predatory characteristics, like I mentioned the balloon loan as an example. And loan documents have to contain full disclosures and the originator's unique identifier. So all loan documents have to pass various federal inspections. There's also new mortgage liability that's been created. Any mortgage originators who violate the duty of care are liable to borrowers for greater amounts. The idea here is just to hold them more accountable. You don't have to remember what the exact standard is. You do need to know that they're liable for greater amounts. Qualified mortgages are privileged by Dodd-Frank. Okay, what is a qualified mortgage? Well, the government decided after the subprime mortgage crisis that they wanted to privilege and promote certain kinds of mortgages and discourage other kinds of mortgages. In particular, they wanted to promote fixed rate mortgages, which are mortgages that have interest rates that are fixed over the lifetime of the loan. That way people don't get into financial situations that they weren't expecting and can't pay for. Okay, so qualified mortgages are defined as the following: fully documented 30-year fixed rate mortgages with no negative amortization features. The APR can't exceed the average Fed prime rate by more than 1.5%. Okay, underwriting has to be based on the fully indexed rate. Income and other financial resources of the borrower have to be verified. So borrowers have to provide lenders now with a lot more financially identifying information than they used to have to do. And there has to be a debt to income test that's prescribed by federal banking agencies that needs to be met. Okay, so all of this dramatically increases the involvement of the government in day-to-day mortgage origination practices because it was thought that the mortgage origination industry couldn't regulate itself, since quite clearly they had done such a bad job of it. Okay, well, a couple more slides here. The BCFP, the Bureau of Consumer Financial Protection, was a very important part of Dodd-Frank. It came out of Part 3. This is an independent bureau that was created at the Federal Reserve. Okay, the idea was to regulate the offering and provision of consumer financial products or services under the federal consumer financial laws. The BCFP was one of the most controversial parts of Dodd-Frank. The reason why it was controversial was because the BCFP was established to protect American investors and consumers from themselves. Okay, it was established to protect people from themselves. Okay, its job here is to coordinate with other federal agencies and state regulatory agencies to promote consistent treatment of consumer financial and investment products and services, the establishment of a victim relief fund. What do I mean by protecting people from themselves? Well, the government basically, in setting up the BCFP, decided that mom and pop could not protect themselves from predatory financial agencies. And so the government decided that it needed to make decisions on mom and pop's behalf so as to ensure that mom and pop were fairly treated. And that meant preventing certain kinds of people from having access to certain kinds of financial products because they were seen as not qualified or not capable of handling themselves. Okay, here's a quick quotation from the website on the BCFP. The purpose is to implement and enforce the federal consumer financial protection laws consistently for the purpose of ensuring that all consumers have access to markets for consumer financial products and services, and that markets for consumer financial products and services are fair, transparent, and competitive. If you remember back to our discussion of marketing ethics, and especially the caveat emptor, caveat venditor distinction, that's something that comes into play here. So essentially, what the government was saying was, what we need to do is set up a system where it's not buyer beware, but rather seller beware, and also we're going to actively prevent buyers from being able to access certain financial products. Okay, and that was the controversial part, was the government set up a two-class system where there were the financial elites who had access to all of the various products, and then there were the rest of ordinary people who did not have access to these products. Okay, so certain kinds of investments, for instance, after Dodd-Frank, were made available only to people who were qualifying investors, and others were excluded from these kinds of investments. Does anyone want to take a guess as to what the criterion was by which the government differentiated between sophisticated and non-sophisticated investors? What was the criterion? Anyone want to guess? It's not education. It's how much money you have. How much money you have. Because it was thought that if you have a certain amount of money, that must be evidence that you are sufficiently sophisticated to handle certain kinds of financial products. Okay, this was Elizabeth Warren's baby, the BCFP. She's the recent Democratic presidential candidate who lost in the primaries last year. Okay, but the idea here is to protect American consumers actively in a way that they previously had not been protected, and to do so by restricting their liberties. Okay, usually liberty restriction for the sake of personal protection has been in the past a progressive ideal, and certainly it was in the case of Dodd-Frank and the aftermath of the great financial crisis. Okay, consumers have to be protected from unfair, deceptive, or abusive acts and practices. Couple of other things about the BCFP. They do financial education programs, they field consumer complaints, and they identify risks. Let me stop and ask if there are any questions about any of this. I've got about 4 or 5 minutes left, and I want to now devote the balance of our time in class to just talking briefly about the paper. So if you'll pull up Blackboard on your device and look under week 8. Listed under week 8 is a sample paper. Actually, 2 sample papers. And if I can't show it to you up here on the screen, otherwise I would, but my tech has failed me and doesn't do this. So pull up the sample paper that reads Sample Business Ethics Paper. Sample Business Ethics Paper. Okay, and this is titled The Negative Impact of Unions and Their Effect on Business Research. This is generally a good paper. Okay, I think I remember giving this paper an A-. It's a good paper because the author is concise. She spends adequate time discussing the topics, but doesn't get too verbose and doesn't spend too much time discussing topics. The introduction works. She's got a nice thesis sentence. Please, in your writing, write thesis-based papers. A thesis is just a quick summary statement at the beginning of the paper, alerting your reader to what you're going to be writing about, and doing so by briefly summarizing, again, very brief, each main section and how you're going to make the argument that you're going to make. Her thesis comes at the end of her introduction. She writes, labor unions are harmful in the retail workplace because they cause companies to collapse or go bankrupt. They cause companies to lose money due to initiated public disturbances in the form of strikes, and they cause an increase in unemployment. Okay, so this thesis works. This thesis works because it is concise. It gives us 3 reasons why she's going to argue that labor unions are harmful. These 3 reasons are distinct from each other, and they naturally progress in a graduated developing argument. Okay, another strength of her paper, and I'm going to be reading down a little bit in the next couple pages, is that she uses topic sentences. So for instance, she writes here at the bottom of page 2, labor unions cause companies to collapse or go bankrupt, which overall harms the economy. Not the most elegant sentence, but certainly a sentence that gets to the point. She then provides a little bit of conceptual expansion on that, and then furnishes her readers with a case, the General Motors case, that talks about how labor unions can do damage to companies. Okay, the General Motors case is instructive for what we just discussed in our lecture, because General Motors was caught up in the aftermath of the subprime mortgage crisis, and they actually went bankrupt. Okay, and the government gave them a bailout, and part of the reason why they went bankrupt was because their unions refused to negotiate with the company and held out for better terms, and ultimately the government rewarded them with a bailout. Okay, the paper is an A- and not an A because she probably spent a little bit too little time expanding on the conceptual aspects of the paper. She does well with her examples and her case studies and gives us some good details about precisely what was happening in these cases, why unions behaved badly in the General Motors case, or a little bit later on page 4, the UPS strike. Okay, and then she has some other examples. But she could have spent a little bit more time telling us conceptually what she's arguing before going immediately to the case study. Okay, a couple of other things I want to highlight here that are strengths of this paper, and then I'll ask you guys if you have any questions about it. One is she makes good use of quotations. It's always good to include some expert opinion when trying to establish a particular position as being correct. But don't just use quotations as word fluff. Don't just expand your word count with quotations in order to just expand your word count. Okay, her use of examples of how strikes do damage to companies, this use is good. New York City Transit strike, the UPS strike. I want to scroll down here to the very end of the paper, to the conclusion. This conclusion, I would say, is fair. It's not especially strong. Okay, the conclusion probably spends a little bit too much time summarizing what was just said. More time could be spent directing the reader to a future trajectory. After having read this paper, she could say, you should now go on to explore these topics, or this argument could be used to support this further investigation or something like that. Okay, a conclusion that's simply devoted to a summary usually is a bit weaker than what it could otherwise be. But on the whole, this is a strong paper. She is a good writer. Her sentences are not always the most elegant, but the case studies are well chosen. She's got good evidence and strong background sources. These sources come from a variety of different areas, including various economic journals, various web sources. I would say this is the kind of a paper that you should be seeking to write. Questions about this paper? Are you guys excited about writing the paper? Isn't it a happy, happy thing to be able to improve our writing skills together through an exercise where you have others walking alongside you? Yeah, I know. When I was in college, papers were like bleeding myself with leeches, so I know how you feel. But if you do have any questions for me, I'm happy to walk alongside you. Email is the fastest way to reach me this week. I will be making available on Blackboard the paper wizard. It will be in, I think, week 12, or then maybe week 13. Let me take a look and see where we are in the syllabus there. And the deadline will be this coming Friday. Okay, so let me direct your attention to that. And if you have any questions, just let me know through email. You guys have a good rest of your day. This PowerPoint? Yes. Yes. In fact, I'm not done with this PowerPoint. I'll have to continue with it on Wednesday. Mm-hmm.
I have a question about this. At the beginning of class, you said we should go there and find a PowerPoint, but I couldn't find the notes. I was wondering if this was it.
So this is what I was referring to at the beginning of class.
Okay, this
Yes,
is it. Okay.
that's it. Yeah, it's an article.
And also, you just said something about you're gonna put something on week 11. What was that?
That's the paper assignment wizard that you can follow when you upload your paper to Blackboard. Yeah, that way it goes through goes through like a plagiarism checker thing. Mm-hmm. Yep.
I don't know if you got my email or not.
I did, Morris. Yeah, thank you. I haven't responded yet. I appreciate your email
I'm
though.
struggling
Yeah.
getting all that information to the test. I don't know. I keep going over the notes. I watch
Sure.
lectures. And
Yeah, me too.
I just kind of have a struggle between